talking about yesterday's comeback. Joining us now, Fundstrat's Tom Lee. It's good to see you as always. So why do you think that was such a significant moment? And if it was, why did we give a lot of it, or at least let's say half of it, back today?
Hi, Scott. It's good to see you. I think there were two things that were important in terms of reactions yesterday. The first is it was an ugly CPI report, really one that nobody could find good in, and the market opened down but closed higher. So that's a market reaction. But I think an equally important reaction yesterday was there was a lot of Fed talk into that CPI report, how Fed officials were saying that they were going to stay the course regardless of what was going to be printed. And even the Fed speak after the hot CPI report has kind of reiterated that, including Bullard's comments today. So I think it's not a Fed pivot, but it's interesting that the Fed, in the face of a pretty hot CPI report, isn't talking about higher terminal rates, but instead kind of realize it's been the right call to kind of rush to get towards that 4 to 4.5% and then pause there. And I think that's incrementally constructive for markets because it's going to provide visibility in terms of the rate path.
You know, I listened to you presumably say how bullish you are or this is positive, but your own technician, Mark Newton, who's a frequent guest on this program, while he's constructive, he's only constructive to a point before you get a turnaround and you go back to perhaps the lows. He says, and I quote, and I want your reaction to it, because I'm always trying to square where you and he are on the markets. He says, quote, bounces will likely prove short-lived and might not exceed 38.50 before a pullback back down to lows gets underway. Any breach of 34.50 argues for a flush to 32.50 to 3,200. Which is not an immediate base case, but a realistic projection on further weakness. Now, are you guys on the same page or not?
Mark and I talk frequently. We have a huddle, and we spend a lot of time in each other's offices talking about markets. Mark's view does reflect how poorly technicals are. I mean, you know, price is the arbiter, and the market's been in an ugly downtrend, which is what Mark's speaking to. But price can change if fundamentals change. And I think in between now and year end, as much as investors are glum and pessimistic, there are things that present themselves as things that can change how price reacts. I mean, I think foremost, I think there's still a growing gap between what is apparent in terms of inflationary leading indicators, whether it's commodities, job openings, home price, market rent for new properties, and how it shows up in the hard data. Now, granted, the Fed is not trusting forecasts, so they rely on the hard data, but that gap is still growing. And the second is there's a lot of geopolitical risks around oil and energy prices, and so much of the inflation and the surge and the change in expectations have hinged on oil, which means if we have any resolution on either the war front, or on oil supply. I mean, I think it's been kind of interesting that OPEC announced a pretty big production cut and oil has barely increased. I think that just tells you that as much as energy is still a wild card and investors are worried about it, I don't know if it's as much an upside skew as people think. But those two represent pretty big, you know, potential game changers for how people view market direction.
I understand, but I still have a hard time. It's almost like the play caller and the quarterback are not on the same page, right? Bounces will likely prove short-lived. That's from your chief technician. Do you disagree with that?
Again, Scott, it's time frames. I wouldn't say I'm disagreeing with Mark, but
Tom, he says that he basically says we're going to go back to the lows before a pullback back down to the lows gets Scott, underway.
Just to be clear, if you read the complete note, that's not true. He actually lays out different paths, but the path that's being read there is one of the directions. So I would just say it is actually a lot more balanced than what you're describing.
Oh, I'm just quoting. Bounces will likely prove short-lived and might not exceed 38.50 before a pullback back down to lows gets underway. I mean,
it's in the same note that talks about S&P potentially a path towards 4,300 as well. So again, I'm just saying that within that same note, there are multiple paths, but you're just highlighting one of the paths.
I want you to react to another a comment that I saw from Stephen Geiger. He's a fixed income analyst at Nomura, and he looks at that reversal yesterday, to which you suggest it was bullish. He says, and I quote, "Yesterday was incredibly bearish in my view, even though most think bullish. That massive reversal took out tons of hedges, puts were closed, bears were purged, opens the door for a much bigger decline in the immediate term." What's your reaction to that, Tom?
Scott, I mean, that's a trading comment, and you know how markets trade in the next day or two or a couple weeks. I wouldn't disagree with those points, but to me, again, I think that there are potential fundamental positive catalysts between now and year end. And so I know that there's price and momentum's negative, but it doesn't mean that that's going to necessarily govern what markets do the rest of the year. It's the same reason people can overlay charts of today versus 2008 and sort of treat that as canon, and that's the direction markets are going. But of course, that's not the only overlay one can do. So Scott, I'd say there's positioning and then there's technicals, but then there's also fundamentals and macro. So as much as investors are betting that it's only going to be technicals or positioning that matter, there are other factors that can drive markets.
Tom, look, I've asked you a bunch of those questions regarding you and Mark, and I know frankly, you sound exasperated with me, but there are a lot of our viewers who are exasperated with you. And the fact that you have such a lofty price target, despite what seems to be blaring in front of all of us, that there's no way to reach some of those lofty levels because of the significant issues that are in front of us. I'll give you the last word. I'm happy to do that. But how do you square that? Because when we have you on and you continue to make these bullish cases in the face of short-lived reversals that seem to be nothing more than bear market bounces, it leaves some people questioning whether they should listen to the advice or not.
That's fair, Scott. I mean, the market's endured a lot of damage in the past month. You know, it's going to be difficult because there is a time window here between now and year end. But at the same time, let's say that our targets are unrealistic, which it is. I also think it's also unrealistic for investors to say that markets go straight down. So, you know, it's been tough. It's been a tough year. Unfortunately, you know, I kind of wish markets were performing better, but we're in a tough situation with inflation, and that's been a pretty tough monster to slay.
Yeah, understood. Tom, I appreciate it. I appreciate you coming on and having the conversation. I always do. It's Tom Lee, Fundstrat, joining us. We'll talk to you next time. It's time for a CNBC